In this video, I will work the example of pricing an endowment life insurance policy. An endowment life is one that pays whether you live or die. It pays if you die during the policy year. This is a 3-year policy. But then at the end of the 3 years, if you're still alive, it also pays. The face is $1,000. Interest rate is 5%. It's issued at age 60. So to do this policy, we're going to need to know L60, L61, L62, and L63. We'll also need to know D60, D61, and D62. Remember, if it's a 3-year policy, whether this is an endowment life or level term policy, if it's a 3-year level term, 3-year life policy, the number of D's in the numerator will be the same as the policy year. So there's 3-year policy, so you need D60, 61, and 62. If you go to mortality table, you can get all of these numbers off of the mortality table. So here is the mortality table. And so we need D60. So D60 is 83,662. 61 is 82,317. 62 is 873, so 60 is 83,662, 61 is 82,317, 62 is 80,873, and 63 is 79,321. And then the D's are 1345, 1444, and 1552 for D60, D61, and D62. So the policy itself, to write out the actual policy, the premium is going to equal D60 times $1,000 divided by 1.05, 1 plus the discount rate. The discount rate is 5%, the face is 1,000, so D60 times $1,000 raised to the first, plus D61 times $1,000 divided by 1.05 to the second, because we'll pay that at the end of the second year. D62 times 1,000 divided by 1.05 to the third. And then for those people still alive at the end of the third year, we're going to pay L63 $1,000 and divide that by 1.05 also through the third. That's real important. On a matured endowment, the very last death benefit and the payment we paid to people alive both happens at the same time at year 3. And if this were a level term policy, you wouldn't have that L at the end. A 3-year level term would just have D60, D61, and D62, not the L63. But because this is an endowment, you'll have the L63 at the end. You divide this by the premium payers. The policy doesn't say how many premium payers there are. If it doesn't tell you, just assume the premium payers are the same as the length of the period of the policy. So if it's a 3-year policy, you're going to have the L60s are going to pay this. You divide that by 1.05 to the 0, which is just dividing by 1. And then you can have people pay premiums at L61. You'll divide that by 1.05 to the first. And then your L62s, and you'll divide that by 1.05 to the second. And so when we put the numbers actually in, my D60 is 1345 times $1,000 divided by 1.05 to the first, plus my D62 in this case is 1444 times $1,000 divided by 1.05 to the second, plus D62, so D60, D61, and D62. 1552 is D62 times $1,000, divide that by 1.05 to the third. And then my L63 is 79,321. We'll pay each of them $1,000, and that's also divided by 1.05 to the third power. Divide these by L60. L60 is 83,662, and then L61 is 82,317. We divide that by 1.05 to the first, plus L62 is 80,373. We divide that by 1.05 to the second. When we do all of that, we end up with a numerator of 72,451,841.05, and we divide that by the denominator 234,960.82, and that gives me a premium of 308.36. So my numerator, my denominator, 308.36. The second part of the question says, show the flow of transactions from a premium payment to the final time the cash is paid. So to do all of that, we'll start off at time 0. At time 0, we collect the premium. Our first premium is paid by the L60s times 308.36, and my L60, you remember from the previous page, L60 was 83,662. So you multiply that out and you get the initial premium of 25,798,014. I'll go out 2 decimal places just so I won't have as big of a rounding problem at the end. And then we're going to invest that premium at 5%, and that's all we do in time 0. And then at time 1, our portfolio matures. So that's pretty straightforward. We take that 25,798,014.32, we multiply that by 1.05 to get us to the end of the year, and that gives us a portfolio at the end of the year of 27,087,915.04. They're going to pay a death benefit. The death benefit is going to be my D60s times $1,000. Remember that my D60 was $1,345, so that gives us a death benefit of $1,345,000.00. We also collect at that time our second premium, this time from the L61s times 308.36. Remember that our L61 was 82,317, so that gives us a premium of 25,383,270.12. So we started when we had the portfolio mature at 27 million. We paid out 1.3 million in death benefits, and we collect another premium of 25.4 million. When we add all of that up, we have the amount that we're going to reinvest at 5% is the net of all of that, which is 51,126,185.16, and that ends the first year. The second, at the end of the second year at T2, the portfolio is going to mature again. So that 51 million we had at the previous year, we'll multiply that by 1.05, and that will give us a portfolio of 53,682,494.42. We'll do the same thing we did last time. We'll pay a death benefit, but this time we're going to pay it to our D61s. Remember that D61, there was 1444 of those. Each of them will get $1,000, so we'll pay out 1,444,000. We'll then collect our premium. This is the last premium we'll collect. We've had 3 premiums we got from the L60s, L61s, so now we'll get it from the L62s. Each of them will pay us 308.36. Remember the L62 was 80,373, and so that gives us a premium from them of 24,783,818.28. And so the net of that will reinvest one more time at 5%. And so that net is 77,022,312.70. That's the end of year 2. Then at the end of year 3, our portfolio will mature one last time. That net portfolio from the previous time will increase that by 1.05 because our investment return assumption is 5%. That gives us a portfolio of 80,873,428.34. We'll pay our last death benefit. This is going to go to the D62s. Each of them will get $1,000. Remember that our D62s was $1,552. So that will be $1,552,000. We're also going to pay the living benefit. Those people that are alive at age 63, they're also going to get $1,000. And so remember the L63s was $79,321. So we're going to pay each of them $1,000. So that will come out to be $79,321,000. And when you take the net all of that, remember it should be exactly 0, but because we rounded our premium to 308.36, so we didn't go out as many decimal places, we'll have a small remainder, and the remainder here that I get is $428.34. You'll probably get a few $100s like that. If you're off a whole lot, then there might be an error, but you could even put into your answer should be 0 except for rounding. So that is everything I'm looking for in that question. If you know how to do this question, you should be able to do level term policies and other policies. Remember, if it's a whole life policy, you just only use D's in the numerator, no L's, and you go to the very end of the table. If it's a level term, you only use D's for the term of the policy. If it's 3 years, you would use 3 of those. And always assume that the number of premium payments equals the number of D's, and the number of premium payments are always the same. Here we had 3 D's and we have 3 L's, unless the problem tells you that it's single premium or limit pay, and in that case I have to tell you specifically that the premium payments don't equal the number of years of the policy. Thanks.